So first of all, thank you. Thanks for taking the time out on a weekday evening. And I know it's absolutely not the best of time, but I did not want to wait till the end of the week. And because of two reasons. One, I thought I'll do this last weekend. Uh, I had a very bad throat infection, so wasn't able to speak much. And I didn't want to wait till the end of this week because I thought, the markets being what it is, bump up the audio. Let me see if I can bump up the audio. I don't know how to do that. Is it better? Is the audio clear, or is there a problem in the audio?
No, I think moreover it's good. Sometimes the voice goes away and then comes back.
Oh,
Yeah, this is better. It's
okay.
clearer. Yeah.
Okay. So basically, let's get started. As and when if you have any questions, keep putting it in the chat box, and we'll get to it at the end. I don't have a lot of Santosh is saying I'm not audible. I'm not sure. I am assuming I'm audible.
Yeah, you're audible.
Okay, thank you. So let's get started. First, mandatory disclosures, etc., disclaimers. Basically, telling you that if you are listening to me and if you buy and sell and if something goes wrong, it's your problem, right? All disclaimers, disclosures essentially mean the same thing. Okay, so I'll just pause for a moment. You can go through this. Okay. The first thing is, let me see if I have the mic. Okay. So the first and most important thing is that we are so okay. Why am I doing this now? Because I think there is a lot of turmoil in the markets. Last couple of months, especially the last couple of weeks, has been pretty trying. Markets have been not only very volatile, it has actually been sort of falling a lot. A lot of people are panicking. Things are not good, right? So I thought in these kinds of circumstances, what is important is to take a step back, evaluate overall context, and see how you are positioned in this overall scheme of things. So the first and most important thing here is that India continues to be the fastest growing large economy in the world. And it's going to be like this at least for the next 3 to 4 years, right? So that is the first and most important thing that we need to sort of remind ourselves. Mic is very unstable.
I think the location of the mic, if it comes near to your mouth, then it becomes more audible.
Okay, is this
Yeah.
better?
Yeah. Now it is much better. Now it is very clearly audible.
Okay, so let me hold this here and then speak. Okay. So the most important thing is that we have to remember that we are the largest, well, we are a large economy growing pretty fast. So that is the first takeaway from today's meeting. The second most important thing is that when we take a when we take a step back, right, and we look at what has happened over the last few years, right, what we can see, and this is something we miss when we are looking at the daily news, whether it's on social media, whether it's on regular media, these are things we miss, right? So if you just take a slightly longer term view and see what kind of growth we are seeing across the country, you will see that in pretty much every, in a large number of important metrics related to financials, that we've made tremendous amount of progress in the last 10 years, right? And I tend to take decadal views for long term trends. So if you look at, say, the number of income tax filers, it's gone up, nearly doubled in the last 10 years. Number of people with returns with more than 50 lakhs of total income, again, exponential growth, nearly 5 times. Household savings, tremendous amount of growth. Overall market capitalization has gone up significantly. Now, there are two parts to market capitalization. One is that the valuation of the businesses that are already in the market, that has grown. In addition to that, we've also had very large companies coming in with their IPOs, right? So recently, for example, we've had, say, Hyundai. It's a very large company. It was not captured in the market cap of India, although it was captured in the GDP, right? So the market cap to GDP ratio of India will be slightly on the higher side compared to other developed markets, because in developed markets typically what tends to happen is most companies which are large and established are already available in a in the trading market, right? They are already listed. In India, that is not the case. In India, we have still very large players who are still private. So, if we look around us, we see a lot of companies, especially the Korean companies like LG, Samsung, Hyundai has already done it. So you look at all around us, I mean, Kia. So all of these, second, let me this off. Yeah. So a lot of these companies are going to come into the market over the next few years. So the market capitalization is going to climb. So remember this when somebody tells you or you read somewhere that the market cap to GDP of India is, has grown exponentially or is out of whack, because right now we are a country where a lot of the market cap is not captured because companies are still private, large ones. You look at, I'll not talk about the number of DMATs and all of that, but we know, right, what is happening all around us. We are seeing this kind of growth. This is the other part of it. Again, if you take a decadal view, if you take a long term view, you see that equities have outperformed significantly, right? So the last 10 years, if you've invested in equities, we've roughly got a 16%, 16.5% kind of returns vis-a-vis any other asset class. So the second best has been gold, and gold has been aided by the run in the last 1 year also. What is interesting here is that the volatility in equity is always going to be higher, right? So if you see, the standard deviation is the highest amongst all, and that is something, again, I will stress upon, right? This is something that we know. Whenever we are getting into the equity markets, we know that we are going to go through ups and downs, and the opportunity for us is that over a longer period of time we will be compensated with much higher returns. And if you take, most decades, this has been the same story, right? If I have a chart here, I think it's probably the next one. Let me just check. Not this. Yeah, this one. This is the log chart of Nifty from its inception. So when it started till now, you look at this chart, right? I mean, there have been periods when the markets have probably not done much for a few years. That happened after the Harshad Mehta crash. It happened in after the dot-com crash. It happened again after the global financial crisis. But overall, for a long period of time, over the last 35 years, the market has been rewarding investors who have kept the faith. Why is that? The primary reason for that is that we are a growing economy. Our businesses keep churning out profits year in, year out. That is the reason why this kind of a graph is there. You will not find this graph in a lot of other countries where the economy is stagnant, right? Where businesses are not growing. So we are, in my opinion, we are blessed to be in a country where the economy is expanding. And this, again, there is a correlation between growth in the economy and the demographics. We are a country where the young population, young working age population is much more than the people who are not directly contributing to the earning in the economy. And as long as that continues, which is likely to continue till about 2045 to 2050, India is going to 2045 and 50. We need to figure out how things will pan out, because then we will be having a demographic decline, right? Already in some parts of the country, the replacement rate of childbirth is already below 2.1. Even all over the country, we are just above it, right? So over say the next 2 decades, we will start seeing a declining in our demographic, decline in our demographic and decline in our population. So that is something we will have to consider when we get closer to that. Maybe, we start thinking about it when we are around 2035, 2040. Okay. The other important thing is that when the markets are falling, people have this fear that, and we hear this narrative about FIIs, dumping stocks and going away, which is true. I'm not disputing the fact. It is obviously the fact that FIIs have been selling relentlessly for the last few months. But the fact remains is that over the last 1 year or the last 3 months, Indian markets are not an aberration to overall emerging markets. We are more or less in line with what is happening across the world, right? So don't, for a moment think that what is happening in India is something completely different or something which is happening only with us. That is not the case. This chart is probably one of the most important charts for today, right? So whenever markets fall, there is panic. Now, if you see this chart, this is the this is the BSE 500 index. From the COVID lows till I think about end of last week, we were up 270%, right? Now, for most people, if I ask you how has the markets been since the COVID lows, most people, probably 99.9% people will say it's been great. But if you see within that, there have been multiple occurrences where the markets have corrected significantly. So there is a phase, if you see, where in 2021, I think it was around September, October, where the fall started and it extended for over 8-9 months, and the market fell nearly 17.5%. The next fall again happened in 22, I think end October, November. Again, the markets fell roughly 11.5, 12%. And now this is the third fall where we are seeing roughly 12, 13% from the top. So the point I'm trying to make here is, even within in this last 4 years, we have seen the markets correct multiple times from the top. And that is the nature of markets, right? We can never have bull markets where it continues to go upwards in one direction. That is never going to happen. You will have, and probably that is not healthy as well. You will have periods of consolidation. You will have periods where markets will correct. You will have periods when the markets will correct sharply. These are all pullbacks in a overall bear market, right? So that is something that you have to be very cognizant of when things are falling like nine pins around us. Okay. So the other point here is that the market overall has gone up, but it has gone up on the back of better profitability, right? So this is again something which we need to remember. So it's not that the market has gone up without any substance, right? The last 4 or 5 years, we've seen increase in profitability and we've seen valuation expansion. So again, this is another chart which is pretty interesting. In the last 18 years, right, two-thirds of the time, 12 out of 18 years, mid and small caps have outperformed large caps. Again, this is something just as a data point we need to remember, that two-thirds of the time, mid and small caps will outperform large caps. 1 in 3 years, you will have large caps doing much better, right? So if you're playing probabilities, you are better off in mid and small caps. Obviously, that there is a downside to it. You cannot get better returns, and there's no free lunch, right? So obviously, mid and small caps also see larger drawdowns. So when the market falls, they will fall slightly or maybe significantly more than what large caps will do. If you are investing for a very short period of time, larger drawdowns is something to be considered and worried about. But if you are investing for a longer period, 5 years, 8 years, 10 years plus, then to me, I think it does not really matter if intermediate drawdowns are slightly more than what you would have got if you were invested solely in large caps, right? Now coming back to current, right? So this is the overall, the top 500 companies. Again, we see in the last 15 years, we are now very close to the median valuations, median PE, after this correction that we've seen in the last, month, 2 months, or maybe 3 months. Same thing we see with Nifty 50. Valuations again are back to the median levels. And I think this is a slide which I just added. This is the one thing which is sort of making me slightly nervous. A lot of IPOs, a lot of QIPs, a lot of offers for sale. If you just see the numbers in calendar year 2024, it's just sort of ballooned. It's never a very good sign when you have promoters of companies coming and sort of taking money from investors. It sort of in a way hints that equity has become very cheap. Now if that is I mean, a lot of it is on the back of good companies coming with IPOs, and I'm always, for having good companies coming with IPOs, because over a period of time, the choice gets broader. You get to choose different businesses, different business models to invest in. So it's very good if we have greater choice. But OFS, QIPs, these are things where, sometimes you get a feeling that people are just taking money because the market is exuberant and money is cheap, and they're taking it just because it is there to be taken, right? That's not always a very good sign. So, we have to be very clear and slightly careful on companies where there's a lot of money raising which is going on. And this is the last slide. So, in this kind of a scenario, what are we as investors we supposed to do? First thing is, whenever markets are volatile, right? Especially when markets are, going down. First thing is to remind yourself why you are investing in equities. Why have you come to the market? Why have you invested? Right? For most of us, it is for wealth creation, for the long term. It's for retirement. It's for goals which are far out. Right? It's not something that you want in the next 6 months, 1 year, or 2 years. So, with if you have that in mind, it will reinforce your behaviors. You will tend not to panic or not to get swayed by what is happening all around you, because today we are in the era of social media and WhatsApp forwards. It's a toxic combination, right? Everybody is continuously getting bombarded with information flow, right? And the friction of action is also very low. So friction of action meaning that it doesn't take much to act on your impulses. It's an app on your mobile. You open it. You don't even nowadays have to put a password. You just put your fingerprint or whatever, and it opens, and one click, you buy, sell, whatever, right? So the friction has gone down. The second important thing is, never invest if your time horizon is very short term, right? Never invest in equities, because equities by nature is a volatile asset class. We do not know, nobody knows what is going to happen tomorrow, right? What is going to happen in the next 6 months? Anything can happen. Markets can go down 20% from here. Markets can go up 20% from here. We don't know. Nobody knows. There could be a catastrophic event. There could be a nuclear war somewhere. There could be, massive natural calamity somewhere, right? There could be, some great positive development somewhere. So don't invest with a very short term time horizon. Do not leverage your portfolio. Don't go and borrow money. Don't take a personal loan. Don't take top ups on your home loan and put the money in equities thinking that I can borrow at 8%, 10%, and I can make more than that in the markets. Don't try to do that. I have this feeling that I forgot who said this. I think I most probably it was Buffett, that you know don't give up something which you don't need. Don't give up things. I'm just butchering the quote, but basically it's like don't give up anything for things you do not need, right? Don't over leverage. Don't take a lot of stress for getting a delta return, which may not be very meaningful in your life, where the downsides could be significant, right? Then the next thing is, don't panic in bad times and don't get overly enthusiastic in good times. Some part of equanimity in your own life is very important to be, a good investor, and to reap the benefits of being a good investor over the long term. Right? If you are, because the markets is always going to be topsy turvy, right? I keep telling this to people. There's this, in Calcutta, Borolin is very predominant, right? And when we were kids, they used to run a ad on TV where the catch line was, I'm saying this in Bengali and then I'll translate. The catch line used to be, জীবনের নানা ওঠাপড়া যেন সহজে গায়ে না লাগে. The many ups and downs of life should not impact you, right? So I always tell this to people, to investors, that have a Borolin with you. The ups and downs of life, and Borolin here is just a symbolism, that don't take the ups and downs of life too seriously, right? There will be times when the markets will do extremely well. There will be times when it'll you'll go mad, you'll feel dejected. Don't let it get to you, right? If you've been long enough in the markets, you'll know that that's all part and parcel of it. Our job is to get decent returns over a 5, 10, 15, 20 year period. And just a simple Excel compound, I mean Excel calculation or a online calculator, just go and compounding calculation and see if you can compound at say a 15% or a 12% or a 18% over a 20-year period, how much money it actually is, right? That is the magic of compounding. It becomes mind boggling. And lastly, when markets are volatile, I think the best thing to do is maintain your discipline. Keep investing regularly through SIPs, whether it's monthly, quarterly, whatever frequency, right? Keep putting in money into the portfolio. Why I say that is because investing, the game of investing, or the outcome is based on return on equity, right? Return on equity basically means the amount of money, the amount of equity you have in your portfolio, the absolute return is going to be based on that, right? So if you have, say, 1 lakh and you have a 20% return, you get 20,000 rupees. If you have 10 lakhs and you get the same 20% return, you have 2 lakhs, right? So the absolute number, I mean, this sounds very obvious, right? But the same thing, if you extend it, if you have 1 crore and if you have 20%, you get 20 lakhs. So the the more equity you have in your portfolio, the better it is. And why I say, keep investing in SI or as, in regular intervals is that even in bad times or good times, the idea is to keep putting in more equity into your portfolio. Okay. With this, I think that is all I had. Let me go back and let's start looking at the questions. Okay. Okay. So the first question that I can see here is from Sumit. Do you think that the mid caps are overvalued and there is a lot more correction to happen in that space? So, see, first of all, people who've heard me or people who've sort of been with me for a while, they know that I don't believe, or I rather believe in the fact that valuation is in the eye of the beholder. So there is no valuation which is, obviously in absolute terms, if you are paying, very high valuations where in normal condition of the growth of the business, you will not be able to get back your investment in, say, 20 years, 30 years, 50 years, then obviously if you're, paying too much. But most of the time I have seen that valuation calls are wrong, right? So instead of trying to look at which companies are valuation, higher valued, lower valued, I think what we need to look at is where is there a comfort of growth, where is there, in which businesses there is good visibility of business outcomes in the next 1 2 years, 3 years. That is, I think, what is more important. Excuse me. The other thing is, I don't believe that we should segregate businesses based on mid caps, small caps, large caps, etc. Having said that, I don't think mid caps are overvalued overall. There are companies which are available at reasonable valuations. There are companies which are, sort of valued, maybe not so comfortably. Right. So it's a call that an individual investor needs to take. I don't think we should ever take a very broad call on valuations because we are not investing in the index, we are investing in individual companies. We should be able to one second, there's so many questions coming, I'm getting sort of distracted, sorry. So we should be able to take a judgment based on that individual company. Okay. The next question is from Urmil. Second. When you get a moment, would you be great if you can share your views on JWL management? Third QIP raise in short time, and this one is significant. Understand if it's completely wait for Talgo in Spain. Wouldn't the earlier QIP panic on account of differential QIP and without significant growth from their investments? And now another QIP. Yeah, I think, like I said before, any company which is continuously coming and raising money from the markets through a QIP or through OFS is something that we need to be very carefully looking at. What is it doing with that capital? Is it going to be able to deploy it meaningfully so that earnings growth comes through? So these are things that we will have to sort of. I don't want to individually talk about any specific company, but that is the overall sort of view that I would want to have. Next question is from Kanchana Anand. Your take on DeepSeek and the impact on India and the US. I honestly think that right now there's a lot of noise. We need to see what is actually happening after this noise dies down. And overall, I think broadly, I think what is going to happen is that we will see more and more such companies or such models coming up from different players, and we will see more and more adoption as well, right? So I don't see that it's going to materially change anything in India, US, etc. Over a period of time, yes, the kind of work or how we use it for productivity purposes, etc., will change. It's going to get more and more embedded into different tools. So how we lead our lives will start looking a bit different, and we need to be continuously tracking what is happening in this AI space, because it definitely has a lot of impact, not only on investing. I think I would say it has less impact on investing, but more impact on our work lives and on our day-to-day lives, right? The impact on investing is probably going to be second order. So we need to keep track of this, because this is changing, and it's going to continue to change very fast. Is one thing. So, for example, I think Chat GPT is now about what, more than a year. I think nearly 2 years old. How has it really impacted, you know, you, or how has it impacted India, US, Europe, whatever? If you think about it, it's not really had an impact, other than you using it on and off for doing some searches, etc. Right? Has it made any meaningful difference to how you do your things? Not right now, but yes, these are advanced technologies. It's going to get embedded into other things. It's going to get embedded in our mobile phones, how we interact with systems. So obviously, this is a very interesting and very unique space that we need to keep tracking. Okay, then the next question is from Geeta. Thanks for the webinar. In terms of sectoral rotation, do you think it makes sense to shift out of sectors that are out of favor in the near term and move to more favorable ones? If so, which sectors would that be? I've always believed that this to be the case. It's not now. I always believe that we should be looking at sectors and companies which are likely to do better in the next 2 3 years and rotate into that. One theme that I personally am looking at is, see, globally, if you see where you have ultimately to make big money, what you have to really do is follow the money, right? And globally, what is happening is increasingly the big money is getting spent by governments, right? We see government capex is what has been driving growth in India. So we need to follow where the government is focusing on, where are they spending, and that is why I think the budget, to me, the only interesting part is where the allocations are. Most of the noise you will hear about the budget is about what will happen to taxes, etc. That is, to me, maybe a 1% interest, right? Already direct taxes or indirect taxes are out. It's GST. It's not within the purview of the budget. What will the government do? I mean, if I'm not mistaken, they will probably not have a lot of leeway to make tinker around with income taxes, maybe here something here or there, right? The main thing takeaway that we should have from the budget is what are the sectors where the allocation is going, right? So last few years we are seeing large allocations in railways, in roads, in airports, etc. So is that theme going to remain, or are we going to see more social sector spending, etc.? That is where I think we need to focus on, and then figure out that which sectors are going to be beneficiaries. I think chemicals are coming out of favor, coming out of sort of hibernation of 2 3 years. I think pharma is going to do well. I think engineering, capital goods is going to do well. I think railways is going to do well. Infrastructure related companies will do well. So overall, I think we are not going to see something materially different from what we've seen before. That's my personal take. Next question is from Sam. Can we start SIP heavily? I don't know what heavily implies, but I would always say that start and continue with with your SIP for as long as you can, right? I mean, it's not for now. I mean, keep increasing your portfolio equity so that as and when the markets go up, right, the absolute percentage makes difference to your overall portfolio. That will only happen if you have more equity in the portfolio. For most people who are salaried or who have businesses, the only way to do it is, or the most easiest way to do it is periodically, whether it's monthly, quarterly, whatever, putting in capital into your portfolio. Next question is from Ravi Mittal. Can you please explain what is happening in J dash dash stock in railway space? I'm assuming it is JWL. I think what is happening in JWL and what is happening overall. In the last couple of months, last 2 3 months in the overall railway sector has been that not only Jupiter Wagons but Titagarh, most other railway stocks have corrected. I think personally it has corrected because it actually did do very well. And when typically what happens is when people try to take money off the table, the first thing that 99% of investors do is they sell stocks where they are in profit. Most people are very loath to sell stocks where they are in losses, right? So if you see sectors which have done really well, companies which have done really well, have corrected in last 3 4 months. Does it mean that their business prospects have soured? I don't think so. Again, we'll have to take a sector by sector, stock by stock call, and especially for things like railway, I think if I just look at the broader macro picture, there are about, I think, if I remember correctly, and I could be wrong on this, there are about 30 odd towns and cities where metro is getting rolled out. The entire fleet of Indian railways is going to get sort of recast over the next decade. So this opportunity space for railways in India is massive, right? So I would not be very concerned if a stock which has gone up 5 times or 8 times corrects 30 40%. It's par for the course. If it does well, if the sector does well, if the businesses do well, they will continue to they'll again pick up. The last 3 4 months have not been good also because the pipeline, because ordering had come to a stop because of the elections, right? So pretty much I think 30th April the model code of conduct got kicked in, and post that I think nearly 6 months there were hardly any orders that came in for railways. I think again it started from the middle of November, and the same thing we've seen in the Kavach orders, in locomotive orders, wagon orders. So again now it is starting to pick up again, and you'll see the results over the next 2 quarters. I think that is how it is. Again, we'll have to go back and see the allocations and the intent of the government in terms of how much they want to spend in this space. Okay. The next question is from Anand. Is EMS sector overvalued? Again, as I said, valuation is in the eye of the beholder. There are two main factors which drive valuation. One is growth, rate of growth, and the second is the longevity of that growth. How long will that growth persist? Now, if as an investor you think that, say, a particular company is going to grow at 20% for the next 10 years, you are going to be willing to, if you feel that a company is going to grow at 30% for 3 years, right? So it's a subjective call that one needs to take. To me, I think understanding the business model, understanding the growth triggers, understanding how long it can grow, that is more important. If you see the biggest wealth creators over the last 20, 30 years, and I've been lucky in my life to have participated in a few of them. So, for example, Bajaj Finance or an HDFC Bank, they've always been overvalued during the 20, 25 years where, you know, they continue to go up. It HDFC Bank for years were like twice the valuation of the next best bank. Same for Bajaj Finance. At one time, if I remember, most banks were available at 1.5 price to book. HDFC Bank used to be 4 price to book. Bajaj Finance used to be 8 price to book. And that went on for a decade. And tremendous amount of wealth got created in that. Right? So don't get into this trap of, this is overvalued, this is undervalued. Just try to under a bit more. It tends to work. Sorry. Yeah. Next question is from Anand. For the 20% cash that we have in long-term equity, do we see more opportunities to deploy it post-budget depending on where government emphasis is spent? I think so. I mean, see, the one reason I did not want to, I want, again, if you've been with me for some time, I've always believed in the fact that, we don't want to bottom fish. I want the market to stabilize and then buy. I don't want to be the brave heart who goes buy something and the market drops 20% from there and we get butchered. I much rather buy it 10% higher. And I always say this, it's always a good practice to average higher, right? If you've bought something at 100, you seek to buy more at 110, seek to buy more at 120, etc. As long as the business continues to do well. So yes, Anant, if we get good opportunities, we'll definitely deploy whatever capital we have. Santosh question is, we currently don't have any equation in the hospital sector or the power transmission sector in our long-term services. Are there any business watch list that we? Yeah, I mean, we have a lot of businesses. I currently have a lot of, and our team also, I mean, we have a lot of businesses in the watch list. We continue to evaluate, different businesses, different sectors all the time. Like I said, I mean, the idea is, so the way we construct a portfolio is like creating a cricket team, right? You might have 10 great fast bowlers playing in the IPL or playing in the domestic circuit. But when you're picking a team, you cannot have all those 10. You have to pick two, three, four, whatever, right? You have to have 4 or 5 batsmen, you have to have a wicket keeper, you have to have a spinner, you have to have a fast bowler. So you have to pick and choose. And in that process, you have to take out someone who maybe, playing very well and, maybe playing phenomenally in IPL. And in your process, you'll make mistakes, right? You'll buy, you get somebody who's not performing, right? And that will always happen. We saw what happened in the Australia series with India, right? We had a lot of players who were great on paper, could not perform. Same thing can happen in the portfolio. Somebody very promising, take him in the team, put in the portfolio, and it does not perform. And something that you've not picked has done, phenomenally well. That's going to happen. You need to sort of accept it and continue to try and refine and get better at selecting. And if something does not do well, you remove it and get something else in. That's the only way to do it. I just wish the Indian cricket team selectors also sort of did that. They had some kind of model of looking at current performance, pick a team. Okay, so next question is from Sagar. Is the railway capex story over? I think Saturday you'll get to know that answer from our finance minister. I am not the right person to answer that question. The next question again from Geeta. When you mention SIPs, are you referring to mutual fund SIPs, or do you also recommend sipping into stocks irrespective of valuations? I'm not a mutual fund person. I do not invest in mutual funds. So I mean, I'm not saying that they are bad. I think they are very useful for people who don't have the time to invest themselves, etc. When I say SIPs, if you are investing in mutual funds, by all means go and do an SIP on mutual funds. If you are doing your own portfolio, go in and do an SIP in your portfolio stocks. Again, irrespective of valuations, like I said, this is probably the third time I'm repeating valuation. Use some basic logic that, okay, this stock has fallen the most the last month, I'll buy this. Or you can use a logic that this stock has, just go alphabetically, or this stock I have lower allocation, I'll buy this. So whatever formula works for you, use it consistently and just keep buying the same portfolio stocks. The whole idea of the SIP is to increase the equity value in your portfolio so that when the market goes up, you are able to participate more meaningfully. That's the whole idea. The next question is from Shaz. Please let us know if the crash in I'm assuming it is JWL, is an opportunity to invest more. So again, these are standard question. I mean, standard response, not only for JWL, for any company, is as long as we have it in the portfolio and you have, up to the standard allocation, 4-5%, you don't have to allocate more. If your allocation is lower, you can always top up, right? And then if, let's say, tomorrow, if that stock is removed from the portfolio, don't get into that mental bias that, oh, I bought it just last week or last month, so let me hold on to it for some more time, etc., kind of thing. If there's an exit call, try and sort of adhere to that and get out and get into the others, any other new recommendation that is made. So that's the whole idea. Again, next, what are your views on JWL? I think I've already mentioned that. Next question is from Rujhan. How much are fundamentals and valuations considered in quantamental as compared to price action? I'm subscribed to. So in quantamental, it's primarily price action. It's Q10, Q30 are both momentum portfolios. So valuations practically are it's negligibly, it's not really considered in quantum interval. You're more concerned about the quality and also the price action and possible potential price action. That's what you're looking at. The next question is from Sam. Why there was no advice to take some money off across equities recommended, sensing market is somewhat in peak, which I think you make out to some degree of accuracy. So that's a good question, Sam. The problem is that we have different types of services. So for hit picks, if you see, we've sort of got out 100%. Quant, in some parts there's some amount of cash. In Quiver, we have some amount of cash. Long term, I don't think we should. Again, long term, I think 10, around 20% we are in cash. But I don't think we should be very concerned about 15-20% corrections in the long term portfolio, right? Because otherwise, what will happen is you keep sort of getting whipsawed, because at only in hindsight will you know how much of a fall you have. You'll never be able to get that right before, because other what might also happen is, if you have, let's say, you decide that okay, no, something is looking bad, and you get out and the market doesn't fall, right, and it continues to go up. I know a lot of people who went out of the market in 2018, right? A lot of value investors, my friends, who went out of the market, and they found it very difficult to get back in even post COVID. And a large part of the rally they missed, right? A lot of, I've been hearing that markets are overvalued. 22. If people take action based on, their concept of valuation, most of the time you will be sitting outside and missing the biggest part of the rally. If you've taken your portfolio, if you've taken out your portfolio, say in 22, you would have missed the, big rallies in 23 and 24. In the overall scheme of things, you probably made, X percentage, and you've lost 20% from the top, which is par for the course. In next 6 months, 1 year, 1.5 years, assuming the way India is growing, the way the business are going, we should definitely see better times. So then, like we saw in the price chart, right? Today, nobody remembers what happened in 21 and 22. Why the markets, why the BSE 500 fell 18%. If I ask you, nobody here will be able to tell me. I also don't remember why the market fell that time. And again, subsequently also in 22, and also the same thing happened. Maybe a year down the line, we'll look back and feel that, again, this was a similar kind of phase. So that is the whole idea. Let's see. I mean, if the markets continue to do very poorly, then we'll have to reevaluate and increase our cash position from 20% to higher. The next question is from Dhruv. What is your opinion on the results of both private banks and PSU banks this quarter? You think at current valuation, PSU banks offer a better opportunity? Your view on the banking sector. I am personally not very bullish on the banking sector. My thought is that right now we are going to see some amount of consolidation in the banks. It's not going to be easy for the banks. Let me put it this way. I'm not very bullish. I think some of the larger banks are maybe reasonably valued. Maybe SBI or a PNB or a ICICI Bank or maybe an Axis, HDFC, Kotak. The larger banks, maybe a federal bank have done, results have done well. But point is, do I have better opportunities somewhere else where there is a decent enough prognosis for the next 2 years? Maybe, right? That we need to, sort of consider that when we. So again, it's that dilemma of picking the cricket team, right? So one is class and the other is form. So you want players in the team who are both classy and in form. Some of these banks are class, but they are probably not in form. You want a combination of both. The next question is from Birsha. Your view on the geospatial space. Also, you had tweeted about GLP-1 opportunity. Do you see any opportunity in this? I think I'm positive on both. I think geospatial is going to do well. GLP-1 again, pretty large opportunity. So yeah, I think they'll do well. Next question is from Sachin. Massive correction in PGEL. Any thoughts around it? No thoughts. I don't think there's a massive correction. So I think it's a normal correction. The stock went up phenomenally as well. So when something goes up a lot, people and the market is weak, there is a inherent tendency for people to take off profits. Has the business changed? Has the dynamics changed? I think they've done. They're doing well. We need to see if anything material is changing, and then sort of take a call on it. I don't think anything materially has changed in PGEL right now. Next is Abhishek. Let me see if there is a question here somewhere. There's a lot of text here, and I don't want to read out all of that. Consumption growth is slowed. Government can continue to spend, but how much? Government can continue to spend a lot. I mean, what has consumption got to do with? I mean, consumption is different from government spending. Government is not spending on your consumption. Government is spending on infrastructure. So they are not directly related. On returns in the last few years, dollar returns are poor than their home markets. That's why they're leaving. With Trump, the possibility of continued exodus can't be ruled out. Yeah, probably. I mean, the thing is that, again, this is a hindsight bias. We don't know what is going to happen in the next few years. My gut feeling is that the next 10 years, it's going to be much better for emerging markets than for the US. I think the US returns have been very concentrated in the top 7, 8, 10 stocks. Overall, the US economy is not doing that well. Europe is in not a good condition at all. The only, the dollar is propping up the US markets. And yes, obviously, a large fund in the US is getting, sort of free, risk free 5% returns. Why would they come to an emerging market? Look at currency problems, uncertain returns. So, yes, obviously, that has been the case. Will that continue to be the case? I am not very sure. I don't think so. End of the day, I think people continue to look for returns. Once people start understanding that tweeting about policy and actually doing something and getting it past the courts and actually implementing is different. I think people will also start realizing that most of what Trump is saying cannot be implemented exactly like he's saying, and that has been in the previous Trump administration period as well. I mean, a lot of thing what he said could not be followed through, and it, the world has changed since then. It's unreal to think that if Trump puts tariffs on large countries, they will just sit back and take it. There'll be retaliation. There'll be counter tariffs. So it's going to be a murky thing. Yes, uncertainty is going to go up. Uh, Markets are going to probably be much more volatile in the next few months, and that is one of the reasons why I wanted to share this idea with you that uh, today the markets have been good, tomorrow it can fall, and so on and so forth. So don't sort of try to formulate a lot of these macro kind of pictures all that much. Let it die down. There's a lot of noise in all of this. Most of the time, if you again take a slightly higher level view, you will see that a lot of these policy things are just they don't have a you know impact beyond the first few days or the first few weeks, right? Uh, and then we'll see. I mean, if there is any major change, we'll have to see. I don't believe that we are now in the era of buying and forgetting, right? We are in the era of buying and monitoring. So that's what we do. We buy and we keep monitoring what is happening, and so if something changes, we update our models and we update our viewpoints about businesses, about industry, and about what can happen, and then we take appropriate action. I see most people have moved from value to momentum. Most momentum strategies exist as stock when the momentum breaks. If most investors are doing momentum, where is an investor's edge? So this is again a age-old problem. This is not new. Momentum has been around for 100 years. Value has been there for 100 years. It is never the same thing. So typically, what will happen is if exactly what you're saying, right? If everyone does momentum, momentum will stop working for a time. If you see the last 6 months, momentum has not worked all that well. You look at any momentum fund, they have not done all that well. Why is that? Because moment in you know there are times when a particular strategy will not work, right? Something else will work, and that is how it is. That is where uh, that is why I always keep saying that you diversify across strategies. Don't only do momentum. Don't only do value. Don't only do growth. Don't only do XYZ quality. You have to have multiple strategies in your portfolio, and that is the precise reason why even in our advisory, even in the PMS that I run, we have complementary strategies uh, to invest, right? The next question is from Vamsi. Would you stay on cash currently, or would you add in a staggered manner to the current portfolio? What is your advice, specific advice to the current situation? So there are two parts to this question. One is, like I said, I will keep adding equity to my existing portfolio. So that's number one. And the second is, my portfolio may have cash component. I will whenever I'm putting, so let's say I have 100 rupees today, I have to I have to deploy that, and let's say the portfolio has 20% cash, so I will put that 20% in a liquid case or a liquid Bs or whatever, and I'll deploy the rest 80% in a staggered manner in an SIP uh, kind of mode. I might buy one day a week, so let's say I buy every Wednesday, at 11 o'clock, no matter what. Or I decide that, okay, every week, any day where the market corrects, I will go and buy, right? And I will, so if I have to, buy for 100 rupees in a month, I know that, let's say, this month there are 4 weeks, so 25 rupees each week. Every week I'll wait, see that if there is a day where the market falls, I'll go in and buy that day. Something like that, right? So have a very simple kind of a formula to do it. Next question is from Kevin. While you've mentioned that we need to be patient and ponder as to why we have invested, but we have exited 40-50% of our positions in Quiver, do you see stocks going down heavily? So Quiver is a different strategy. It's a shorter term, uh, you know, uh, kind of strategy. That is why if you see a hit picks or a Quiver, we have more cash component compared to others, uh, compared to say a long-term portfolio. So as and when markets pick up again, we'll get very quickly deployed back into 100% in Quiver, in hit picks, etc. So it depends. The cash component depends on the kind of strategy you are running, the kind of time horizon that strategy has, and not specifically about the view of the market, right? I am starting to slowly uh, trying to take myself away from trying to forecast what is going to happen in the market. I don't think it is really possible. Most of the time, 99% of I or nearly 100% of investors will go wrong trying to forecast markets. I think it is better to have simple processes to follow, which is sort of trend following in nature. So you might get in or get out slightly later than the tops and the bottoms, but it would sort of protect a large part of the fall. That is the whole objective, and you remain in business and you remain deployed for a bulk of the capital that you have, so that when the markets turn around, you are able to participate and get back in the markets. Next question is, any thoughts to switch from PI Sera since 1 year? Yes, definitely. These are active consideration to switch out of stocks where the not only the returns but where also the business prognosis is slightly in questionable mode. The next question is from Sashank. Is it possible to move to cash and bond before the monthly rebalance in such market situations? Similar to what we did for. Yes, it is definitely possible, but we see, again, these are things that you will see in hindsight, right? During the month, let's say the markets are going up, okay, and today is the first day, say the market falls 2%. Uh, do you take an action? No. Okay. The next day again it falls. Do you take an action? No. Let's say the third day it falls. The fourth day it goes up, right? Fifth day it falls. Sixth day it goes up. Seventh day it falls, right? Until and unless you get to a point where you your sort of either your stop losses are getting hit or your system is telling you that you want to exit, you don't want to sort of preempt and get out, because understand one thing about stop losses. Uh, Stop losses will always lower returns, right? If you are able, the best thing is, I know a lot of quant guys who don't use stop losses at all, right? They are okay to sit through even 50% corrections, because what happens is there is a concept called as return clustering. What that means is that bad days and good days come in quick succession. So, for example, if you see uh, yesterday and today, right, it was a bad day and a good day coming together. So, if you were out of the market day before yesterday, or if you got out of the market yesterday, you would miss the recovery today, right? So, this is a very interesting conundrum to have, and globally, I don't know of anyone who has been able to solve this problem, right? That, is there a foolproof or a fail-proof way to get out of the market uh, and to get back in? There are no ways of actually doing it enough, doing it right all the time. So whatever you choose, there will be pros and cons of it, and you will get to know only in hindsight whether you are right or wrong, right? So what we try to do is we try to follow a process depending on the strategy that we've seen, that we've been running. And if for those who've been with us for the last 5 years, you've seen that most of our strategy, or I mean, not most, all the strategies have been fairly, successful across market cycles. We try to sort of see that we get out of a bad phase with as less cut as possible, and then we try to also see that we get meaningful appreciation when the market turns. Can we do it perfectly both sides? Definitely not, right? The next question is from Saurav. What are your views on real estate stocks? Sarah has been going up and down. DLF has gone down recently, despite positive. I think, I mean, I am positive about the real estate cycle. Uh, Obviously, Sarah, DLF, I'm positive on these companies. The results have been reasonable. I think the real estate cycle has a lot of steam still. If I look at the numbers that are coming out, have been pretty good for most of the good real estate companies. So I think sometimes we need to be slightly patient uh, with some of these stocks. Uh, we don't know when the actual movement comes. Uh, that's about it. Next question is from Ritin. Thanks a lot for hosting this session. I wanted to inquire, when will the subscription to the long-term equity be reopened? I understand SEBI over-regulation isn't helping with compliance matters, but I do hope you don't intend to close down. I don't intend to close down. We've sort of now, over the last 5 years, built up a small team of research team, and I think we're doing reasonably good work. Uh, we are trying to explore newer avenues, doing a lot of quant work, we're doing a lot of work with machine learning. I continue to keep learning different things. Uh, LLMs are my new hobby. Keep experimenting, keep learning on that. Uh, Other than researching companies, etc. But I think uh, the regulation, etc. are not helping. Definitely, that's for sure. It makes a lot of unnecessary sort of effort, time that you have to put on it. The team needs to spend a lot of time on that, on compliance, etc. It's a burden, it's a cost. Let's see. I mean, I don't have any plans of closing it down, but when will it be open? Our IT guy is trying to get the recurring subscription thing going, because uh, whoever I have taken feedback from, they're saying that they don't want this 3-month they have to come back and resubscribe all the time. So they need a subscription kind of model that sort of auto renews every 3 months for a year, 2 years, whatever. So we're trying to get that done. There's been some technical challenge, so hopefully we'll get it open maybe a few days, maybe a week from now. Having said that, the small cases are all open, so people who want to get in, you can subscribe to small case. That is the compliance part is taken care by small case, so less headache for me, for our team there. So that is still open. The long term hit picks, quant, quiver, all the small cases are open. So that's something good, at least. The next question is from Rupa. As an investor, we expect more guidance for long-term portfolio when you suggest for buying a small investor like us are investing in SIP mode, especially if you're thinking for selling a stock. Rupa, can you just maybe elaborate this question slightly more? I'm not sure I understood what kind of guidance you are talking about. If you elaborate on this, I'll try to take this question. The next question is from RKVK. Most of the growth post-COVID has been thanks to government capex. When do you see private capex taking the lead? Honest opinion is I don't see private capex coming in immediately. I don't see private capex happening other than in the areas where there is PLI. Right? We are not in a phase where there is capacity constraint in the private space in most sectors. So at least for the next 1, 2, 3 years, I think we are going to be led by government capex and PLI-led capex in the infra kind of space. I think that's and that is one of the reasons why I also mentioned that we need to be looking at the budget to see the allocations of the government, because you need to understand the who is the biggest spender, what are their priorities. Let me put it that way, right? So that's what we need to look at. Next question is from Sachin. As an investor, we are tempted to add more of stock which is corrected. For example, ideal allocation may be 2%, but if a stock has corrected 40%, should one add more? There is always risk. Okay, so let me try to understand this question. You're saying that if the allocation for a stock is 2% and you already had 2% and the stock has corrected by 40%, should you add more? See, my personal choice is that never add a stock which has fallen a lot. Just flip your thinking. Try to always add stocks which are going up rather than stocks which are falling. Right? Because you don't know if a stock has corrected 40%, it can correct 50%, 60% also. Right? So if it has corrected 40%, made a bottom, and then it is moving up, then you might, if it has corrected 40% and now it is 30% below its highs, then maybe you can, sort of start buying. That is what I always prefer buying on the way up rather than buying on the way down. It's very emotionally torturous to buy on the way down. Okay. Satish, any update on the renewal subscription? I already mentioned. Right now, I don't have any updates. I don't have any updates. Small cases are open in case you want to go through that route. Siva Kumar, do you invest in the same stocks that you suggest to us, or you take more risk and invest in microcap SME? I do invest in the same stocks, and I also take much more risks. I do invest in a lot of microcaps. I don't invest in all that many SMEs, maybe one or two. But most of the times, so I invest, I have my investments in the PMSs that I run. And I also invest a lot in a lot of small caps, which are high risk. A lot of illiquid kind of names. We continue. Okay, next question is from Siva Kumar. We continue to ship in your suggestions, but might tell exit after 6 months, so you can suggest hold or buy monthly in the portal. Okay, I will do that, but in general, uh, it is better to buy, right? Hold is only when you've got to a up to the allocation that you have, right? Typically, otherwise, the whole idea of an SIP is you keep adding equity to your portfolio, right? So as long as you keep buying higher and higher and you keep adding to your portfolio value goes up. Even if at some point, if I want if you have to exit a stock, you exit and buy something else where the prognosis is better for the next few years. So think of it always in terms of equity in the portfolio, not as positions that you are buying or selling, right? Think of it as 5% of the overall portfolio that I have. The next question is from Shobit. Sir, are there any rules when to sell irrespective of the market conditions? See, broadly, there are general rules to sell. One is obviously if you have a better idea, because cash is always going to be constrained. You will never have, even Warren Buffett does not have infinite capital. So if you have to sometimes buy something, you'll have to sell something else. So that is one of the first things to do. The second thing is if the business is not performing, or if if you have a stop loss in mind, or if you have a time stop in mind, that gets triggered, you get out. Uh, if you have, if the business is doing something completely different from what you thought it would do when you bought it, then you sell. So these are broadly the rules that you have for selling. One thing I can suggest that I have followed in my life is I never sell on valuations. So I usually never sell uh, just because a stock is highly overvalued. I mean highly valued or overvalued. Because I have had this. I've paid the price for having done this multiple times, and I don't want to repeat that mistake. A stock which is overvalued can remain overvalued for decade, and you will miss out on huge compounding opportunity if you're selling based on valuations. uh, I think it's always better to sell based on other conditions if you get better ideas, or if the business itself is stalling, etc. Next question is from Rujhan. Follow up to counter. Are you planning to go to cash, keeping the market conditions in mind? Again, it's a model. I don't know how the market is going to behave tomorrow. Today the market has gone up. If tomorrow it goes up, if we get a pleasant surprise in the budget. In fact, after interesting thing about the budget for me this time is, I think many years, after many years, I'm seeing a budget where people have zero or no expectations. In fact, people have negative expectations. So if something, small, good thing comes out of it, the market can actually rally. I don't know, right? So it's very going to be very sort of premature to predict what we will do. I think, like I said, it is always important to uh, sort of look at what is happening and then sort of take a call on what is happening. Nagesh, what is the difference in thesis of Q10 and Q30 since both are rebalanced once a month? So basically, one Q10 is based on absolute momentum, Q30 is based on relative momentum. We've had a write up on our site somewhere. I will, also it's been on our blog. You can just sort of Google it, my name or Intel Sense and difference in Q10, Q30. I think you'll find that there's a, sort of more detailed explanation there. Okay. So, Rupa, I think you just written your view. Please let me see if you explained it later. Okay, my point is selling call is not decided arbitrarily. If you consider a stock for sale, then let us inform us in terms of hold to avoid new cash deployment. Okay, so I understand where you're coming from. So I think what a number of you are saying is that if I think that we will sell something, or if the team thinks that we will sell a stock, before that we should put it in hold. so that you don't deploy additional capital in your SIP mode, right? I think that's a fair ask. We'll try and sort of do that going forward. Okay. Uh, so see, basically, now my thought process is slightly unconventional in these respects compared to what you might hear from other investors or when you read in books. Uh, for me, most of the time, it is either a buy or a sell, because every day, what is a hold? A hold is basically every day morning you are deciding that this is a company that you want to retain in your in your portfolio. There very rarely you get into a situation where you you have a stock in the portfolio that you do not wish to own. For me, if I do not wish to own a stock, I will sell it. If I want to own it, I will continue to buy it at higher and higher levels. So for me, these are the only two things that is there, right? I don't know whether I was able to explain myself, but that is the way I think. I don't intuitively have a hold uh, status in my mind for any stock in any portfolio. So either I'm willing to buy it or I'm willing to sell it, right? Okay, the other point is which Anand, I think you have put here, is that if there is a hold and a new investor is coming in after a few days or a few weeks, if we are recommending a sell on that stock, uh, so my question is, what is the problem with that? So for example, I buy a stock A because it is there in buy. After say 2 weeks, I get a sell recommendation. I've put in 100 rupees. Today it is either 98 or 102. I sell that and put it in stock B. I am looking at it always at a portfolio level. I'm not looking at it that okay, I have to make money on stock A. It doesn't matter whether I'm making money in stock A or I'm making money in stock B. Right? I'm concerned that my portfolio should be giving me overall returns. Okay. I hope I was able to answer that. Uh, so next question is, there is no way to reach IntelSense. No one answers the phone. There should be a way to reach out if there are any concerns. New member not at. Okay, so I don't believe in WhatsApp groups. There's too much of noise, uh, and it wastes everybody's time. So that's number one. Second is that based on the new rule, previously we had a phone number where you could WhatsApp etc. call. I have asked my team to stop responding to that after December 8th circular, because now the regulation is we need to have a record of all calls. Uh, all calls need to be recorded and archived, right? I don't want my guys spending their entire day recording calls and archiving by name that okay, this person called, whether he's a subscriber, not a subscriber, etc., etc. It's a waste of time for everybody. So the only way right now that is open, that is feasible, is to write to us at equity@intelsense.in. I think we that team is able to revert back within 24 hours most of the time, excluding weekends when people are on leave. But I think we, just email us. I think that's the only practical way today in today's circumstance, because I don't honestly want the hassle of recording every call and then archiving it, and it's a pain. Uh, okay. Geeta, it would be of great help if you conducted these webinars more often. Thank you for today. Yeah, I mean, honestly, I intend to do it every time. And then I get sucked into so many other things. But I actually also enjoy these questions. There are a lot of things that sort of triggers in my mind when I talk to all of you. Uh, and I've been trying to do the monthly videos. Uh, I'll try to do this more often, definitely. At least let me try and sort of make let me pledge that I'll try and do it at least once a quarter. Uh, and then take it from there. Once in a while, if you see that I'm not doing this, do drop me a mail, and then it sort of triggers me. Actually, today's session was also triggered by a similar mail, because somebody just sent a mail saying that you sort of not done a session for a long while, and the markets are sort of topsy turvy. Can you do it? And yeah, I mean, I didn't want to mention your name, but yes. So and that sort of got me going in. I wanted to do it last week, but my voice was completely gone. So today I thought middle of the week, but doesn't matter. Uh, from Kanchana, any reason why we did not participate in the defense stock rally? Yeah, because predominantly because of my foolishness, and because I was stupid in a way. I am somehow mentally biased against PSUs. Have been that like that for many years. It has taken me a while to correct myself, but by that time, most of the PSU rally sort of got over. We were able to participate in a very small way in Quiver through, I think, Mazgaon. We got a very quick, I think, doubler in a very short period of time. But I mean, you're right. We missed a very big opportunity. Uh, but yes, I mean, bad on bad on our part, and I wish we could have got into that bandwagon earlier and made some money for ourselves. What else can I say? Bad miss. In hit picks, which we had not purchased many NBFCs when Nifty was. Yeah, I mean, uh, there will always be hits and misses. There will always be stocks, which in hindsight, you'll feel that better not to have got into. Sometimes you'll feel that you should have stayed longer, etc. So uh, yeah, I mean that's always going to happen. Uh, why did we miss out on power sector, small data center plays outside Cummins? Again, I think power sector. Uh, Again, I would say a similar kind of thing. I mean, I found other stocks where I thought they will do better. Again, in I think Quiver, we had a very good rally. We participated in Apar Industries for a very long time. Uh, in the long term, we had Cummins that has done really well. So across different strategies, we've been able to perform. I mean, participate on and off. But yes, I mean these sectoral themes, we've been able to participate partially. We've not. Maybe if we had concentrated more on Uh, but again, probably that is hindsight. We're trying to put in. We had, you know, we had railways, we had power, we had. So Cummins was a combination of power and data center, etc. So we're trying to get different stocks across different industries where we could do well. Some of them worked, some of them did not. So we have to keep going back and revisiting why some stuff did not work and some did. Next question is from Shobit. Thank you for taking all the questions. Much appreciated. Do you think stocks like Dixon, Keynes have overreacted due to DeepSeek news. What are your views on Dixon particularly? I think Dixon has a long way to go. I think all of these stocks have a long way to go. The opportunity size is huge in India. We're just scratching the surface. Valuations are not, like I said, it's not obviously very cheap, but again, valuation is in the eye of the beholder. Dixon, even this quarter, the results were reasonably good. So let's see. I mean, I don't think the reaction was for DeepSeek. I think personally, I would say it was more of panic selling that I was seeing on the screen. People were taking money off the table wherever there were profits. Let's see how it goes. My gut feeling is the next 2 3 months is going to be topsy turvy, uh, and then we should see again a good up move for the next year and a half. So I am personally fairly long term bullish. Long term, as in not long term, but medium to long term. And very short term, I am a bit circumspect. I don't know uh, which way the wind is going to blow because short term, there are too many uncertainties. There are a lot of push and pulls. Uh, uh, Donald Trump tweets something, something happens. Uh, whether it is actually, can be followed through by policy, no one knows. But the market reacts. Uh, but that is going to increase the volatility. It is not going to change the trend, right? So we need to look at interest rates. We need to look at what is meaningfully happening on a policy perspective, uh, and where the money is flowing. I think that is going to be a bigger indicator of what is going to happen over the next few. Uh, uh, so Kevin, that's a good one. I don't know whether you've jinxed Quiver. I have a friend to this is very interesting and very humorous thing. A very close friend. Uh, he's started investing with me in Quiver around I think August. And before that, for 5 years or more than that, he's been following me. He's been talking to me pretty much every other day. And finally, in August, he says, "No, Abhishek, I have to get in." And he has this perfect track record of being a contra timer. I mean, what he's like the Jim Cramer of India, right? I mean, uh, and we all joke about it, right? He also jokes about it. He says that if I buy this stock, it will fall for sure. And when he invested, I should have sort of thought about it and realized that this could be the top and figured something out. But I didn't, and we sort of been a pretty horrendous 4 5 months for Quiver, and pretty much for most momentum kind of portfolio. But I'm personally very positive. I think over the next 2 3 years, 5 years, I think Indian equities has got a lot to give us. So we should not get overly worried. We have to keep the faith. You know, equities, the kind of wealth creation that equities can give us is just phenomenal. We cannot even imagine, and it just needs faith. It just needs to tune out noise, especially when markets are very topsy turvy. And that's why I sort of that is if you forget everything about today's session, I think the only thing you remember is that India is a growing economy, and in most in growing economies, businesses do well. If businesses do well, they make more profits. If they make more profits, we make more money. It's as simple as that. It might not be correlated on a day-to-day basis, but over a 6 month, 1 year, 2 year period, it should work out well. Next question is from ARN303470. Wow, this sounds like some alien takeover of the world. But how about capital? goods theme, is it over or still have a long way? I don't think it is over. I think manufacturing capital goods is going to be the theme for the next 10 years, right? We will see bouts of overvaluation, correction, sideways movement, etc. But if you see slowly, what is happening globally is a lot more of self-reliance, Atmanirbharta, whatever we call it, across the world. People have started realizing that you cannot depend on external entities for everything. You cannot be dependent on China, on Vietnam, or on Russia, or on US, or on India, for whatever, right? So there will be a lot more of development in manufacturing in most countries, right? So the era of globalization is, on a decline. I am very, very clear on that. We will now see more and more uh, fragmentation uh, than in the last, say, 3 decades that we've seen. So we are, in a way, getting into a new era. Uh, okay, so Navneet, yes, thank you. Uh, if someone has good cash at hand, will India or US be your bet? For now, 10 years, India for sure. I think US probably has topped out. You cannot have 20% of the global GDP and 65, 67% of market cap. It is not sustainable. It is going to mean revert. 20 year 2000 to 2010, emerging markets did much better than US. 2010 to 2025, you've seen extremely good performance by US, primarily because of tech. Now you also see a democratization of tech with China, with DeepSeek, etc., etc. You will say that uh, uh, so I think US, the dominance that the tech has had and the markets have had is going to decline over the next 10 years. So if I had to put in money, I would put it in India. And Shobit said, maybe even a China ETF is not a bad option. China is it's not going to be a growth market very quickly, but it's probably the worst is over for China, in my opinion. I could be wrong. Next question is from Shashank. I say this in every webinar. You said that you will start posting some interesting charts. Uh, can we see that sometime? Charts, as in, are you talking about technical charts or what kind of charts? Because I started posting a lot of charts on my newsletter. I have a chart section now on the newsletter. Okay, you want technical stock charts? I can do that as long as you promise that you will not take it as investment advice. I can definitely start putting in charts. Uh, it will be good if you can give your comment on all long-term portfolio stocks after quarterly results. We do a review. We don't usually update comments, but you know, if there are any comments to be updated, see, again, like I said, my mind works in a binary mode. It works, and I have taught my team also to think in similar terms. It's either buy or sell. So what is it that I am going to give you a commentary here? I will say that this company looks good, it's performing well. You can anyway read that in the commentary that we are publishing. If I feel that it is not doing well, I will sort of get rid of it and get something else in. So just a case in point, I think somebody had asked and I missed that question, is why did we sell I think KPIT or something like that, if I'm not mistaken. So was the question right? Okay. So I know. So basically, if I feel that the next year, 2 years is not going to be as good as we hope, or if we get better ideas, we switch. That's it. Simple as that. Uh, Question from Urmil: Do you invest in US stocks? I used. Oh, sorry. This question is from Neil. Do you invest in US stocks? I used to. Now it's become too painful. Too many regulations, TCS, etc. So I've stopped doing it. But I track US stocks. Yes, I track. Uh, I do track. I keep getting mails and messages from friends in the US saying that when will you start an advisory for US stocks? And since 2020, I have been saying that we'll do it sometime, but we never got around to it. Uh, Urmil, do you see lab-grown diamond as a structural shift? I don't know. I think lab-grown diamonds and original diamonds will coexist for some time. Uh, I have not studied it very deeply. I had recently been to Antwerp and to Amsterdam, and went and visited a couple of diamond, uh, you know, factories, if I may call it that. And their view, probably extremely biased, is that lab-grown diamonds will not take over diamonds, the real ones, and real diamonds will retain their value. I am not so certain. I think the snob value will, go away to an extent, and maybe we'll see some kind of uh, lesser demand and for original diamonds. That's my opinion, but I don't have a very firm opinion on it. I don't know enough to have a very firm opinion. Okay, I think we've been here for 1 hour 45 minutes, and I will stop here for today. Thank you all for being here, and I promise we'll do this more often. And please keep sending me your questions on the email. I do read all emails, even if I don't uh, reply to all of them. The team is sort of growing, and they are doing it. But I I read each and every email. Thank you, and thank you for all your good feedback. And the email ID is equity@intelsense.in. It's there on the website. Just keep sending it. My personal email is abhishek@intelsense.in. You can send your mails to me. Again, I read all emails. I may not respond to all because, again, for me, time is very precious. I don't want to sort of respond. I don't want to be always in the responding mode, right? I want to have time to do my own work, do my research, do my thinking. Uh, so that's it. Thanks. Thanks again for joining, and have a wonderful time. And hope we are able to create a lot of wealth together. Thank you.